Hello, everyone. This is Jim Therese. I and the Rutgers Center for Employee Ownership are very pleased to welcome Aziz Tahch to our conference to discuss valuation. Aziz is a managing director in the Valuation Advisory Group and the ESOP and ERISA advisory practice co-leader at Stout, the valuation advisory and consulting firm. He has experience in the valuation of companies, business interests, and securities for numerous purposes, and he has extensive experience in the valuation of business ownership interest in employee stock ownership plans. In addition, he has performed analyses related to ESOP security formation and transactions, the determination of transaction fairness and adequate consideration, and annual employer security valuation updates. Aziz is also a member of the Rutgers Center for Employee Ownership Advisory Board. Aziz is here to present about valuation fundamentals related to ESOP transactions. Aziz, thank you very much.
Thanks for the great introduction, Jim, and I look forward to presenting on this topic. I'm going to pause here to share my screen, and hopefully it comes up. So today, what I really want to talk about, I want to talk about valuation, but I want to talk about why valuation is so important in the context of ESOP transactions. Some of the things we consider in putting a value on a privately held company that doesn't trade on a public stock exchange, the generally accepted methods and approaches to valuing privately owned businesses. I want to talk about demystify some of the jargon around business valuation. And then I want to talk a little bit about the qualitative factors that could affect a company's value. So after that, I'd be happy to answer any questions. So the first question is, I'm thinking about doing an ESOP transaction. Why is evaluation necessary? The reason is, according to law, when an ESOP is going to purchase a company, the ESOP can't pay more than fair market value. And when an ESOP is selling a company, it can't receive less than fair market value for it to be a valid transaction. So as in connection with any ESOP transaction, evaluation of the underlying business has to be performed. In addition, at least annually, there are reporting requirements related to the ESOP administration. And when ESOP participants leave or retire or diversify their shares, they also need to know how much their stock's worth so the company can buy those shares back. When in the context of an ESOP transaction or annual ESOP valuations, the Department of Labor sets forth some guidelines around what an independent appraiser means. And really it's independent of all the parties. The appraiser will be hired by and report to an ESOP trustee or the fiduciary of the ESOP plan. The valuation itself, even though the company is going to use it to buy back stock, it's really exclusively for the ESOP trustee and the trustee's role to make a determination of the fair market value of the stock held by the ESOP. So as I mentioned, the valuations used for the original ESOP transaction, annual updates that are at least done on an annual basis, and any subsequent sale of employer securities. So before we get into the methods and the approaches that we as valuation advisors use in coming up with a fair market value for a privately held business, I wanted to talk about some terms and some concepts. So in the context of an ESOP transaction, there's really two concepts that the trustee is looking at. One is simply is called absolute fairness, which is simply, is the ESOP paying more than fair market value or getting at least fair market value for the stock the ESOP owns? There's another concept called relative fairness, which valuation professionals and appraisers help trustees with in the context of an ESOP transaction. And that is the concept of, is the ESOP being treated fairly relative to other parties in a transaction? So, for instance, if an ESOP owns 30% of a business and another shareholder owns 70% and that company's being sold, the ESOP may be getting a certain price that's higher than the underlying fundamental value of the shares. But if another shareholder's getting relatively more, it still may not be fair from a relative fairness perspective. So that's another analysis the appraiser helps the trustee do in the context of the ESOP transaction. So a few other concepts. If you're doing an ESOP transaction, or if you're an ESOP company and you hear the phrase adequate consideration, that is defined in the proposed regulations promulgated by the Department of Labor under ERISA, which states that an ESOP can't pay more than adequate consideration for the stock it's purchasing. So how is adequate consideration defined? It's defined as fair market value as determined in good faith by the ESOP trustee. So again, it's really the ESOP trustee's job to determine fair market value, and to help them fulfill that job, the trustee will hire an appraiser or valuation professional to come up with an estimate of fair market value. Fair market value, it actually has a very specific definition. It's in the Internal Revenue Code. It's in the proposed regulations governing ESOP plans under ERISA. That definition is a price that an asset would change hands between a willing buyer and a willing seller when neither party is under any compulsion to act and to transact, with both parties being generally well informed about the subject asset. So it does, there's a few elements to the definition that are important. It posits a hypothetical willing buyer and willing seller. So it's not just done from a buyer's point of view or a seller's point of view. It's really the price that transaction could get done at the intersection of a willing buyer and a willing seller. It assumes hypothetical parties. So for instance, specific synergies that a specific buyer might pay for can't be factored into a fair market value analysis under most circumstances. And it assumes a transaction that that either party is not compelled to do. So, we often, when we're doing an analysis, there are certain transactions in a company's industry that might represent fire sales or distressed transactions. The pricing evidence from those types of transactions aren't anything that we would be able to factor into our analysis. A few other definitions that are really important. You'll hear the phrase enterprise value a lot when you're dealing with private company valuation. And enterprise value simply means the operating value of a company in total, before carving out how much of that value goes to debt holders, how much of that value goes to preferred equity holders, and then how much is left to common equity holders. Equity value is what's left. If a company's enterprise value can be thought of as kind of a pie. A slice of that pie is really if a company has debt, a slice of that pie is really the bank's claim on the value of that pie. If a company has preferred equity holders, they get another slice. Whatever's left over after all those slices, that's what's there. That's what we call common equity value. And that's usually what the ESOP is acquiring and owns going forward. So similar to a house, if you buy a house for $100,000, get an $80,000 mortgage, your equity value is $20,000 because $80,000 of that is really owned by the bank who gave the mortgage until that mortgage is paid off. When we're doing evaluation for ESOP purposes, many ESOP companies are 100% S corporation, 100% ESOP owned S corporations. And if you're familiar with S corporations, they're pass-through entities. ESOPs are tax exempt entities. So 100% ESOP owned companies don't pay any federal income taxes. Regardless of that, when we're doing our valuation, we assume the company is a tax-paying C corporation. And this goes back to the definition of fair market value. We're assuming a hypothetical buyer and a hypothetical seller. So a specific tax benefit like the ESOP S Corp tax benefit is not something we can factor into our analysis under this fair market value standard. So that's just an interesting nuance of doing valuations for ESOP companies. So how does the ESOP value or the company valuation process work in an ESOP context? So really the first step is information gathering. We'll usually send out an information request. The typical items on that request are financial statements, historical financial statements, projected financial statements, company's capital structure, its debt structure, items like that. Then we often conduct a site visit, or these days we're doing more Zoom visits, just given the current environment. The management interviews are a big piece of our process. The numbers only tell you so much as a valuation analyst. A big piece of our analysis is going to be the company's strategy, their business prospects, understanding their customers, understanding their suppliers, market segmentation, getting a better sense of competition and where the company sits in terms of competitive positioning. None of those things really come through just by looking at a balance sheet or an income statement. So management interviews are a really key part of the valuation process. Then we'll also look at third-party data. So we'll look at similar companies that are publicly traded. We'll look at market studies, economic databases to come up with third-party data sources for our analysis. From there, we will apply the 3 generally accepted valuation approaches, and there are really only 3. We're going to get into them as part of this presentation. First is the market approach. And generally speaking, the market approach is a valuation approach where we try to derive valuation evidence from companies that are similar, not identical, but similar to the subject company, using either publicly traded valuation information or publicly available information around change of control transactions for companies in a similar industry. The income approach is the second generally accepted valuation approach, and it's probably the most theoretically correct valuation approach, but it also comes with some challenges. But at its core, the income approach is valuing a company's equity based on the expected future cash flows that the company can generate for the shareholders, which is really, it's a fundamental theory of corporate finance. But to do that, you also have to predict the future, which is never an easy task. The third valuation approach that's generally accepted is the asset-based approach, and that is simply looking at a company's balance sheet assets and subtracting its liabilities and trying to put a value on equity using that method. The challenge with that is most of the companies we work with are operating companies, where the majority of the value is held in intangible assets, intellectual property, company's brand name, its customer relationships, its trained and assembled workforce, its know-how. And none of those things really show up on a company's balance sheet. So the asset-based approach is an approach that we use for real estate holding companies or bank holding companies, but not something we use in most cases for operating companies that are generating positive earnings. So we'll use the various valuation approaches, and at the end we'll weight them, we'll consider which are more appropriate, and if there are discounts or premiums that we have to apply to each method, we'll apply them at the end, as we'll see momentarily. So I want to go into just a little more detail on each of the methodologies and approaches. The first approach I discussed, the market approach, there's really two methods under that approach that we use, that we commonly use. The first is the guideline publicly traded company method. And that's a method of valuation where we look at publicly traded companies that operate in a similar industry to our subject company, and we derive certain pricing evidence from those publicly traded companies and use that evidence to value our subject company. The guideline transaction method fundamentally is very similar, but instead of looking at publicly traded companies and the pricing evidence in the public market, we're looking for change of control transactions involving similar companies, and we're trying to derive pricing evidence from the transaction prices, and then applying that evidence to our subject company. So really the first step of the guideline publicly traded company method is identifying a set of similar publicly traded companies. There are a lot of databases we can use to do this. We could look at SEC filings, which are all publicly available, but we really try to focus on similarity of the market, and we try to find companies that are exposed to the same risk and return characteristics in market events that our subject company is exposed to. So again, we're not really looking for identical companies. That doesn't exist. But if we're valuing a privately held engineering company, we might look to find publicly traded engineering companies that are affected by federal infrastructure spending and construction spending in certain geographical areas, things like that. And then once we select or identify a certain number of publicly traded companies, we compare our subject company to those public companies. Now, a lot of times those companies are going to be a lot larger, maybe more diversified. It doesn't make them irrelevant for the purpose of this analysis. Our valuation, you might have heard, is as much an art as it is a science. So what we're trying to do is we find these publicly traded companies, we develop multiples of earnings. You might have heard the phrase price to earnings multiples before. In the valuation profession, I think a more common metric we look at are enterprise value to EBITDA multiples. Enterprise value, again, is the total operating value of the guideline companies. EBITDA is a phrase or it stands for earnings before interest, taxes, depreciation, amortization. It's just another measure of cash flow for these companies that adjusts for certain differences in capital structure and level of debt and how a company depreciates its assets. So we develop these enterprise value to EBITDA multiples, or enterprise value to book value, enterprise value to revenue multiples for all these public companies. And then we look at them and we say, okay, how does our subject company compare to these public companies? Are they larger? Are they more diverse? Are they more cyclical? Do they have more customer concentration? So we go through an analysis like that, and then we pick multiples to apply to our subject company's EBITDA or revenue or book value based upon that comparative analysis. So I'll try to give you an example. This is just an example for this presentation, but let's assume we're valuing a food company, a privately held food company that ESOP's looking to buy. We might find these publicly traded food companies, and we would compare them, look at their growth, their historical margins, do some digging into their customer base and the diversification. And then we would apply, we see in this situation, they're trading for a range of EBITDA multiples from 9 times to 15 times, and revenue multiples from 0.5 times to 4 times. And then we might say, all right, our subject company, smaller, less diverse, maybe not growing as fast. So we are going to select multiples at the low end of the range for our subject company. We might do an analysis like this where we try to find some relationship between profitability and the level of revenue multiples these companies are trading at. In this specific example, there's a positive correlation between profit margins and revenue multiples. So in other words, these public companies, the ones that have a higher earnings margins, also are trading at higher revenue multiples. And this is what it looks like at the end of the day. So we select multiples based upon this analysis. We apply them to the subject company's fundamentals. So here we're applying it to EBITDA and revenue. And then we come up with a range of indicated values that we weight to come up with a concluded range of enterprise value. And again, this analysis differs based on the company, based upon the industry. Here we're showing a 3-year average. So if we're valuing a company that's cyclical and has cyclical ups and downs, we might look at longer averages. We might look at a 5-year average or a 7-year average. For growth companies, we typically like to look at trailing 12-month earnings or even projected next fiscal year earnings, because for companies that are growing quickly, more recent earnings levels are more indicative of the company's earnings capacity going forward. The guideline transaction method, it's almost the same process, but instead of looking at publicly traded companies and deriving multiples based upon publicly traded pricing data, we try to identify change of control transactions, and we use the transaction price as the numerator and the target company or the acquired company's earnings as the denominator. Then we try to do the same comparative analysis. This analysis, this method, it could be a little more challenging for a few reasons. Number one, timeliness of data can be an issue. So in the publicly traded guideline company method, we're using publicly traded companies whose pricing is updated by the second. And so we're using the most recent available pricing data. For transactions, often transactions could be 2, 3, 4 years old, and they don't necessarily reflect economic conditions as they exist today. So sometimes it's hard to find recent transactions, even if there might be a good transaction in a given industry for a particular company. It might be 3 or 4 years old, and the data could be stale. It's also harder to identify transactions with publicly available information. A lot of the transaction activity we're seeing these days is with private equity buyers. And private equity buyers, they're not public reporters. They don't necessarily have to disclose information about the purchase price or a target company's earnings data. And so it's harder to find information for private equity transactions. The last challenge is a lot of change of control transactions involve strategic buyers. And getting back to the fair market value standard, a strategic acquisition, so a situation where one company is acquired by a competitor, that transaction price might reflect strategic or synergistic benefits only available to that buyer. Now, that's not always the case, but it just requires a little more research to see if we can identify whether or not there's strategic or synergistic elements of value in those types of transactions. But the analysis is fundamentally the same. And here, here's another example of, here's some transaction multiples in this industry. And we would look at these multiples, do the same sort of comparative analysis, and apply the multiples to our subject company's earnings or revenue or whatever metric we choose to use. So I want to move on now to the income approach, which, as I mentioned earlier, is really the most theoretically correct way of valuing any asset, any security. The value of any investment is really, by definition, the present value of the future expected economic income that asset is going to generate. So when we're using the income approach to value a privately held company, the method we mostly use is called the discounted cash flow method. And the starting point for that discounted cash flow method is to come up with the company's cash flow that could be available to distribute as a dividend or distribution to common equity holders. The calculation for that, this is one common calculation. We start with earnings before income and taxes. The reason why we're starting with earnings before income and taxes, or earnings before interest and taxes, is because we want to estimate enterprise value. And when we estimate enterprise value, we deduct debt separately. So we don't want to deduct interest expense at this point because we're going to deduct debt separately. If we were going to value the equity value directly, we would deduct interest expense at this point. But that's not how we normally conduct valuations. Although, again, there's always, there are lots of situations where we're valuing equity directly, just a sort of a case-by-case basis. So we start with earnings before interest and taxes. We deduct hypothetical taxes, even if the ESOP company doesn't pay taxes. We add back depreciation and amortization expense. Those represent non-cash expenses. And so since we're trying to estimate cash flow, we add back depreciation and amortization, but then we subtract capital expenditures and working capital investments. For most privately held companies, those represent actual uses of cash that don't show up on a company's income statement as an expense. So we have to deduct those. And what's left is free cash flow available to invested capital holders, both debt and equity holders. So we do that for a company. We do that for each projected year of the company's financial projections. But as you know, a dollar you get 3 years from now or 5 years from now is not worth as much as a dollar today. So we have to discount those future cash flows back to today's dollars. So we have to come up with a discount rate. And the discount rate really represents an opportunity cost or a required rate of return to induce an investor to invest in the subject company. So, in other words, if I had a dollar today, I could either invest it in, a treasury bond, or I can go out and buy a mutual fund, or I can make an investment in the subject private company that I'm trying to value. But to do that, if I, as an investor, was going to make that investment in the private company, I would require a higher rate of return because it's more risky than a treasury bond or a diverse portfolio of large cap stocks and mutual fund. So there are methods that we use to come up with a discount rate, and that discount rate is meant to reflect the specific risk associated with the subject company. The most common measure of a discount rate we use is called the weighted average cost of capital. And really that's an overall discount rate based upon the rates of return of debt and equity. So when we're valuing a business and we're trying to come up with a business enterprise value, which includes the value of both equity and debt, we need to think about the cost of both the debt and the equity in the company's capital structure. And then at the end, when we're valuing a company, we usually get projections from a company, and that's usually for 3 to 4 or 5 years. But obviously, companies have value beyond the 3 to 4 or 5 year period that we get projections for. So we have to estimate a terminal value for the business. That just represents the value of a company beyond that projection period we get. There's really 2 methods of doing that. One's called the Gordon growth, perpetual growth rate method. And that just assumes that at the end of the projection period, the company's cash flows are going to grow at some sort of steady state rate, similar to nominal GDP growth or inflation, or whatever sort of steady state growth rate is appropriate for that business in that industry. The second method of estimating terminal value is called the exit multiple method. And effectively, that method assumes that the company is sold at the end of that projection period at some multiple of EBITDA or EBIT or revenue. And both are accepted methods for valuing a company's terminal value under generally accepted valuation methods. This is just an example of how we develop a discount rate. And as you can see, it's really a buildup of several smaller components. So we start with a risk-free rate. Risk-free rate, we use the 20-year treasury bonds as a proxy for that. And that's just saying, if I had $1, what's the least risky investment that I could put that dollar in, and what would the return be for that? And historically, we've always assumed U.S. Treasuries is the least risky investment out there. But again, for a privately held company, that's riskier than investing in U.S. Treasury bonds. So you have to add some premiums to that. Another premium we add is the equity risk premium, and that just covers the additional risk associated with investing in equities over treasury bonds. And what we do for that is we look at long-term returns on large cap publicly traded companies over treasury bond yields over a long-term period. And then there's something called a small stock risk premium, and that risk premium is just there to compensate for the risk associated with smaller companies relative to larger companies. And to estimate that, we look at returns of small cap publicly traded companies over large cap publicly traded companies over a long time period. And then there's something called the company specific risk premium, and that is based largely on analyst judgment, and that is meant to capture any sort of unique risks or idiosyncratic risks associated with the subject company that aren't captured in these other risk factors. So that's how we come up with the cost of equity. The cost of debt is usually based upon some market-based debt factor. And then we weight equity versus debt either based upon the company's capital structure, the industry capital structure, or some sort of appropriate long-term capital structure for the company. And this is an example of how this analysis is performed. We have projected future cash flow. We discount that projected future cash flow using that weighted average cost of capital. we estimate a terminal value, and then we discount that as well. And then that gets us a range of indicated value for the company. But you can see, even though it's the most theoretically correct way to value any investment or any business, there are some downsides to it. And a couple of those downsides are it's highly sensitive to a few key assumptions. So if you vary the discount rate a little bit, it could have pretty big impact on the conclusion of value. The terminal value is often a significant portion of the total value. The discount rate has certain limitations and can be subject to some uncertainty as well. And just the very act of trying to project earnings is difficult. Most companies we work with, they're pretty good at forecasting for 1 year out. Beyond that, it just becomes more difficult because you don't know what you don't know. So even though it's the most theoretically correct way to value a business, it also has some challenges. And so that's why, to the extent possible, it's always best to use 2 or 3 valuation methods and then synthesize it at the end. I already sort of talked about this. The asset-based approach is simply looking at the market value of the assets less the value of the debt to come up with the value of the equity. It's not really a suitable method for valuing operating companies with a lot of intellectual property or intangible value. So we often consider it, but we often don't use it. So we come up with these indications of value using ideally 2 or 3 methods. There's some other adjustments we make. We think about if it's appropriate to add a tax shield for the ESOP tax benefit, but that's a very sort of company-specific question. We often add a discount for limited marketability. And the discount for limited marketability is based on the theory that a privately held company, an investment in a privately held company, is worth a little less than an investment in a publicly traded company because it's easier to convert your investment in a publicly traded company to cash more quickly. So if you own a few shares of IBM and you needed cash, you just go to your Schwab account or E-Trade account, hit sell, and that stock is converted to cash instantaneously. It's different for privately held businesses. Now, ESOP companies, there is a statutory put option, which means that if you are a participant in an ESOP and you work for an ESOP company, if you leave or retire, the company is legally obligated to convert your stock to cash at some point. So there's a ready market for ESOP company stock, but it's still not quite as liquid as publicly traded stock of IBM. And so there's typically some discount for limited marketability applied in the context of an ESOP valuation, usually around 5% or so. So at the end, we think about the strengths and weaknesses of each valuation method, and we try to assign weights to one versus the other. So, for instance, if we're working with a company that is really good at making projections or has a lot of backlog or a lot of visibility into performance, we might weight the income approach more. If we have a company where we found really good publicly traded comparables, we might weight the market approach more. But that's sort of the analysis we go through in coming up with the synthesis of value. That gets us to a conclusion of enterprise value. Then we add cash, we subtract debt, and we deduct any other sort of liability, deferred compensation or options, things like that from the conclusion of value to arrive at a concluded equity value available to common shareholders. So this is an example of what a conclusion page looks like. And we divide by the shares outstanding to come up with a per share value. So that's sort of the nuts and bolts of ESOP valuation. I do want to touch upon a few qualitative factors that we consider that could have a bearing on business valuation. Some things we think about: strength of management, depth of management. Companies with a deep bench of management are often worth more than companies with key person risk, where one individual drives most of the strategy, or where one individual drives most of the sales. Anything that increases diversification, so customer, product line diversification, regional diversification. Like, here's an example. Let's say we have two companies, same size, same projected growth rate. One of those companies has one customer, one of those companies has 1,000 customers. The company with 1,000 customers is worth more because the loss of one customer would not have a material impact on the business, versus the other one, the loss of one customer would put that other company out of business overnight. Market position, recognition, companies with brand recognition, brand loyalty have pricing power and are typically worth more, all things being equal. Compliance, risk management, company with a high level of quality control procedures, risk management procedures are often worth more because that reduces the risk of litigation or warranty claims or product failures. Growth potential and required capital expenditures. So all things being equal, companies that have a higher growth prospects are worth more. And companies that have lower capital expenditure requirements, and I'm talking about maintenance capital expenditure requirements, typically trade at higher multiples because that means there's more cash available to be distributed to the shareholders. Other factors, working capital cycles, so companies that could turn working capital more quickly, collect receivables more quickly. If they're converting working capital to cash more quickly, they're generally worth more. Some things affect valuation that you can't control. General market conditions, market crashes, recessions, things like that. Those things can affect a private company's value, but they're generally outside of a company's control. So with that, I'll wrap up. I hope you found this presentation helpful, and I'd love to answer any questions that you might have. Thank you for attending my presentation today.
Aziz, thank you very much for that presentation. And everyone, thank you for listening. We hope you'll join us for some discussion afterward.